I had a talk with YieldMax ETFs with two of their executives, and we covered a lot of phenomenal topics, including ULTY strategy change and how this impacted the ETF, how it grew from 200 million to 3.5 billion in AUM, their new weekly pair SLTY, similar to ULTY but different and very, very unique, how to implement that. We also talked about overall the market and how YieldMax funds work in different markets, what their target audience is, how the income portion and options portions work with these, and last but not least, are there new weekly pairs coming from YieldMax, and are we seeing any more convert from monthly to weekly? We have a ton to discuss, and I'm really excited, and I'm very grateful to the YieldMax team for jumping on this conversation. We had Mike Venuto and Michael Khouw, their new strategist. Mike Venuto is from Tidal, the umbrella company that incorporates YieldMax, and it was just phenomenal. So I'm very, very grateful to both of them for coming on the channel and to Josh for setting it all up. So I'm not going to talk too much. I know you guys are going to be really interested in these conversations, particularly on the weekly pairs, in particular, again, on ULTY, one of my favorite weekly paying dividend ETFs. So there's so much to get into, but don't forget, if you're interested in YieldMax ETFs, in monthly and weekly dividends, to like and subscribe. That way you don't miss out on future conversations. Thank you guys so much for watching. Let's roll that intro. For Mike K, can you share what drew you to join YieldMax and what excites you the most about your role?
Well, it's interesting because I was drawn to the product, as many others have been before I was even introduced to Mike Venuto or to Jay and the rest of the team. In fact, I was actually talking about it on a live stream of my own. The reason I'm interested in it is, I've been in the options business since the late 1990s. The options market has grown by volume and notionally at a compound annual growth rate that significantly surpasses the fixed income markets, that significantly surpasses the equity market. And ETFs have significantly outpaced the growth of other investment vehicle wrappers. And the interesting thing is that this is early days. We have probably $14 to $15 trillion that are managed in ETFs now. When I first got started, I can remember when SPY was introduced, actually. I was on the American Stock Exchange. They started to trade ETFs from the balcony up there on a permit. And it's done nothing but explode since then. It's a better wrapper for investors. It trades like a stock. There's some tax benefits as well, full transparency. So it's, to combine these two things, it's basically represents everything that's important in the business since I joined it. So I think that's reason enough to be pretty excited about it.
Definitely, definitely. And Mike V, what was it about Mike Khouw that made you feel like he was the perfect fit for the strategist role?
Yeah, this is a great question. It's interesting when we were thinking, okay, who can we bring in here to be the YieldMax strategist, right? Meeting with the YieldMax partners. You met a lot of them at the NASDAQ and stuff. And one of them actually ran it through ChatGPT. And who would be a great spokesperson strategist on behalf of YieldMax? And Mike's name did come up. The other names, a little different, a little bit more, let's call it show, and less of when I sat down with Mike for the first time, his knowledge of the industry impressed me, right? Like he understood the compliance, he understood the business end of it, he understood what can and cannot be said. It's just we don't want a snake oil salesman in here, right? We want somebody who really understands this and really understands the importance of educating investors, of explaining how things work, embracing that transparency of the ETF. But that was my turning point. Everybody else was already on. They're like, oh, Mike's great. And I was like, all right, let me see if he passes the compliance test. And he passed with flying colors. I bet you never thought you'd be brought on because of compliance, right, Mike?
Having been in the business and worn so many hats, I wouldn't have thought it would be a reason why someone would say, gee, we'd like to have you here. But it is a really important element of the business. Anybody who's been doing this for a while, whether it's buy side or sell side, I've done both, just knows how easy it is to step into the bear traps that are lying around all over the place. It's not bad intent when people make those types of mistakes. And I'm not going to claim that I haven't made some myself along the way. It's probably why I'm so cognizant of it now. But it is important. It can be highly disruptive to your business if you don't pay attention to those things. It's just a fact of life when you're in the securities business.
And Mike K, touching on that a little more, how did your background prepare you for leading in the option income ETF space?
Well, it basically touches on anything and everything I've ever done in the business. I started off working for a prop firm, Stat Vol Arb, in the option space is what I did. Actually, the first product that I traded options on was the oil service index, which basically was the precursor to ETFs themselves. So before ETFs became very popular, the way that people would get industry or sector exposure was by trading cash settled indices. And then ultimately the Philadelphia Stock Exchange in particular listed a lot of options on those. So you could trade the semiconductor index, the bank index, in my case, the oil service index. And obviously, these are options-based strategies, so that's really where I come from. I actually have I've been a PM of an ETF. I've also been an analyst working for a hedge fund, and I've worked making block markets on the wire for institutions like YieldMax and like Title more broadly. So, at some point or another, if you've been in the business as long as I have, you kind of touch on all parts of it. And so I have some exposure, some longer, some shorter, but to almost everything involved in the whole process. So I think that made it a good fit for me as well.
That experience, I always say experience is the best teacher. It's a very common quote. And yeah, amazing. I love that. And so this is going to be some broad questions for both, whoever would like to answer. How do you think about using options as a consistent tool for generating income rather than just a speculative trade?
I'll let Mike go first.
Okay. Yeah, I think this is really important, right? So I think options coming out of COVID kind of got a bad rap because people were using them essentially on speculation. These strategies that we're doing at YieldMax are designed to harvest the implied volatility of a stock and distribute it as a form of income. I think it's very important that we understand these are completely different things. Like speculation is going long some out of the money call or put, or even worse, selling one of those uncovered, right? That's speculation. Covered call in a systematic way is a form of investing that's been done for decades to generate yield, and institutions do it. YieldMax has democratized that access for retail. I don't know, Mike, would you like to add anything to that?
Yeah, I mean, it's interesting because selling covered calls is in many ways as old as options trading itself. And options trading itself dates to ancient Greece. So Thales of Miletus, he was a philosopher back in the day. So we're going way back, and he basically he knew there was going to be a good olive harvest, and in order to take advantage of that, you need olive presses. So what he did was he went around to all of the owners of olive presses. And if you look at ancient olive presses, one of the things you're going to notice is these are not something you just make overnight. In many cases, they're carved out of stone. They have heavy wood components. So, I encourage anybody who's interested in saying, yeah, how exactly did people harvest and squeeze olives for olive oil back in the day? And he knew that he was going to need access to these to take advantage of that. And so there was an economic reason for him to want to buy calls. So he actually did this. He went out to people who owned olive presses and said, I'll give you a little bit of money if you can guarantee to make this thing available to me when I need it at your prevailing rental rate. So whatever it is you charge. And from the perspective of the people that had these things, not knowing whether the olive harvest was going to be good or bad, they looked at it and said, well, we hope we get to rent our presses. We hope that you come and you exercise that call, because if you do, then I've collected the premium and a good thing has happened. And another thing I like to tell people when it comes to selling options rather than buying them, and I'm not denigrating buying options. Sometimes people have insights. They want to lever those insights. Sometimes people have positions. They want to hedge those positions. So buying options can make a lot of sense. But when it comes to selling options, one should consider that three things can happen. The underlying asset can rise, it can fall, or it can stay where it is. And if you're short an option, two out of the three of those is a good thing for you. And one of them is arguably less bad. So the odds are increasingly in your favor if you are short options premium. The co-author of my book, who's now a professor at Rutgers, Mark Guthner, I literally got off a phone call with him just before we started this. And he mentioned to me that he's planning to retire pretty soon, and sooner than he expected. And when I asked him how that happened, he said, I've really been doing a lot of active cash covered put selling, and it's just been working out great. And I've known the guy for 20 years, but apparently he said, this keeps up. He's probably got 2 or 3 more years of teaching as a professor, and he's going to move to California and buy a house on the beach. So
Huh.
there's something to this. That's the short version of the story.
I love that. Yeah, it's amazing. I'm not much of an options trader myself. I've dabbled in it. I enjoy it, but I also am not an expert in it. So I like to pay fees and have other people do it for me. People that have, more experience and whatnot, which I think is a growing thing among retail investors. How does the options income approach compare competitors' high yield strategies such as leverage income ETFs in both a bull and bear market?
Yeah,
Well,
I'm going first on this one because this is
Yeah.
the one that burns me so much, right? So it's ironic. Tidal launched the first ever weekly income ETF. It was in partnership with SoFi, had a great ticker. TGIF, thank God it's Friday. And then we had a second one that was weekly, WEKL or WKLY. One was bond income, one was equity income. But the yield on these things was like 6-7%. This was 4 years ago when there was no option income ETFs yet, or meaningful ones. They didn't take off. Nobody wanted it. Then comes about, the option income. We get nosebleed yields and people start liking weekly because it's enough to get, it's like, I didn't just get 1 penny. I got like 30 cents this week. That's great. So, we listened, the YieldMax partners listened, and we moved things like YMax and YMag and ULTY and a few others to this weekly payout. Then a not to be named competitor came out and said, we're launching weeklies too. But they're not doing covered calls. They're simply 125% levered and handing you back your money. It is truly return of capital, right? There's no income being produced. And I think because they put the words income and weekly, they're confusing people and it's misleading. I'm shocked that the regulators haven't come and made them clarify it, right? But the amount of work that the 40 people on the Tidal trade desk are doing to generate true income from selling volatility on underlying stocks is massive. And then you have these other people saying, here's a stock, it went up 10%, so you got 12.5%, here's your 12.5% dividend. I don't know what the hell they're going to do when these things start to go down. There is going to be a bear market for these things. How are they going to generate income from leverage in a down market? I don't know. But yeah, this one sparks me. So I'm done on the soapbox, but Mike.
Yeah, it's really funny when it comes to options, there are certain terms that get thrown around. Income is one, decay is another. And, this is, I think, when these terms get misused, investors are being misled. And I think that's really a hazardous proposition. I don't think what I'm about to say is controversial to anybody. And that is that when you introduce leverage, and leverage can be a very powerful tool, sometimes, properly employed, a very effective one. But when you introduce leverage, you're introducing more risk. It's pretty straightforward. If I have $100,000 and I buy $125,000 worth of stock using margin, if the stock goes up, I will benefit. And if I take some of that money off the table, when it does go up, that can feel like a good thing. But whatever capital remains is still levered. So a 1% decline is not going to be 1%. It's going to be 125 basis points. Or a bigger decline is going to be much more. And if people are doing this in high beta underlying assets to begin with, this is a situation that is, setting up for considerable pain, I think, for those who don't understand what it really is.
Very interesting. And I had a question pop into my head. Again, not to name any competitors, there's a lot of leverage ETFs out there. How do the expense ratios vary? Because when it comes to especially weekly options, I imagine you're doing a lot of writing work, a lot of research. From a leverage perspective, should they be close to the same amount if you're maintaining a leveraged ETF versus one that's focused on options, or should there be a disparity between those?
Well, to me, certainly you should charge more for the options-based strategy. It's more complex to effectuate. It is more complex to monitor. It requires more expertise. There are a lot more pieces to it. So it deserves to be, I would actually say, one of the most novel thing about these options-based ETFs is the price at which people are getting them. Because these are strategies that I know a lot of options-based hedge funds that don't even charge 2 and 20, that charge 5 and 30, 5 and 35. Options-based strategies typically command a higher premium for the manager. Employing, as you point out, leverage in a systematic, and I shouldn't call it a stupid way, because, by the way, there are a lot of levered ETFs which very fairly describe themselves as such. If a guy runs a fund and he says, I'm a 2x levered, S&P 500 fund, I don't take issue with that at all.
Mm-hmm.
And whatever the market will bear in terms of what they want to pay that guy to do it versus somebody else, that's totally fine. It's not a particularly complex strategy, and it's going to be a linear payoff that's just going to be a slope of 2 less your fees relative to the underlying asset. So pretty easy for us all to figure out what's going on. I'm not 100% sure why someone pays a manager to even do that, because why can't you do it yourself? But that's another story.
Mm-hmm.
The answer is certainly the options-based strategies deserve to be better compensated. The bigger issue is whether or not people know what they're buying and whether the description on the tin matches what's actually inside.
Interesting. Mike, do you have any comments additionally to that?
Yeah, so one of the things I've always said is ETFs are so transparent that people forget to look, right? Like they just they assume it almost like you take a mutual fund strategy, somebody's going to really look into it, or a hedge fund. They hear ETF, they say, oh, no, the name must be accurate. Like I used to point to the fact that the Vanguard small cap ETF is 85% mid caps, right? But nobody goes and looks. You can, it's very easy. Vanguard just has a different definition of mid cap than the CFA Society.
Mm-hmm.
So people need to know what they own. That's the most important part here. You can see every ETF has to disclose it every day. We go a little bit further with YieldMax. We're disclosing our actual trades and things like that. You can see that these leveraged funds simply own a swap. There is work in managing that swap, but it's nowhere near the amount of complexity that we're dealing with when you're rolling Misty 4 times in a day, right? Yeah.
Very interesting. I appreciate you guys being open about that. Jumping into a new fund by YieldMax, let's talk ULTY and SLTY. So what is SLTY's investment objective, and how can it be used in tandem with ULTY?
I think you take that one, Mike.
Okay, sure. So for those who aren't familiar with these two, I mean, unlike some of the single stock products, there's a couple things that I think are important for us to remember. First of all, these are diversified because with respect to the underlying assets. So you're dealing with a portfolio of stocks rather than a single underlying issue. The other thing I think that's important about ULTY is it has more operating flexibility within the confines of its investment strategy mandate. So they have more flexibility with things like hedging. And the important thing about this is, you had asked a question earlier, and I think it plays to these quite specifically, which is, should managers of options-based strategies get compensated more? Well, there's a lot more to these. One of the descriptions that I've heard, because I was talking about hedge fund fees, is that, you could describe these as more of a hedge fund strategy in an ETF wrapper, which I think is, important. And you can see that too in the total returns. Take a look at the total returns for ULTY over the last year. Compare it to a diversified long ETF, because ULTY has a long bias. And you're going to see that the total returns, when I was looking at this yesterday, I didn't actually check this morning. I can check it right now, but it was like 22.5% on the year. If you had reinvested it, compared to, probably 17 or so for the S&P underlying. I can actually double check. SLTY has a bearish bias. What's important for people to remember is that these are not inverses of one another. Even if they held the same underlying stock positions, which they do not, but even if they did, they still wouldn't be the inverse of each other. And let me give you a simple example. This isn't the strategy being employed, but I like to illustrate things in a way that makes it sort of conceptually easy to get your arms around. If I sell a put on a stock, I'm taking a neutral to bullish position on that stock, and I'm looking to collect premium. If I sell an upside call on that stock, not necessarily an advisable strategy because it carries unlimited risk, but then I'm taking a neutral to bearish position on the stock. But selling an upside call is not the opposite of selling a downside put, right? So that's really an important thing, I think, for folks to remember here. But then, of course, there is the element of stock picking, which is a difficult thing to do. Ask any long-only manager. Look at the SPIVA reports, see how many long-only managers actually outperform the S&P 500 or the mid-cap if that's their mandate, or the Russell if that's their mandate. That's actually one of the hardest ones to beat. And you're going to see this. And For individual investors who are just beginning to familiarize themselves with options-based strategies and their benefits, if you're going to ask them to say, okay, you got to pick the stocks and pick the options that you're going to trade it on, long and short, that's a lot to ask. And I think this basically sort of takes care of all of those things. You have basically the tailwind of a positive carry portfolio mandate in general. We're not always bullish. We're not always bearish as investors. So depending on your positions, and look, you may have other holdings that give you sort of excess long beta to the market. So maybe SLTY, just as a natural hedge to that, is a better product for you. So it's going to vary. And I think just the more basically arrows you have in the quiver, the better off you're going to be. But I think, I was asked what was the product that excited me most when I joined. ULTY is it, and now we have SLTY since I've joined.
Mhm.
We're kind of rounding it out then.
I love that. And we have more ULTY questions in the pipeline for sure. But next, I want to ask, how do the portfolios differ under the hood? And why should an investor care about that distinction?
So you're talking specifically about SLTY versus ULTY?
Yes.
Okay. So I think when SLTY launched, we had one overlapping position. And so it was because it was a name that was going into earnings and there was more vol to harvest, right? Earnings, there's a seasonality with harvesting vol that links to earnings, right? NVIDIA is supposed to announce tonight. So the vol on NVIDIA is much higher today than it was a week ago, right? It's basically pricing in a 6-point move or $6 move, whereas 2 days ago it was pricing in a $2 move. So earnings moves things. That's the times where you might have overlap between SLTY and ULTY, right? Most of the time they're not going to have overlap because one is using momentum signals to find long bias stocks, and one is using other momentum signals to look for stocks that should be in decline or have negative momentum. So, it's really just tools for our investors to use. You want a portfolio that's long biased, you have ULTY. You want a portfolio that's short biased, you have SLTY. And both are harvesting the volatility of a diversified basket of securities to give you, on a weekly basis, a distribution of that volatility. How'd I do, Mike? This is more your
I think
end.
you did great. I think you did great. And on top of, and why wouldn't you?
Yeah.
I mean, as you pointed out earlier, the transparency is something that ETF investors really should take advantage of, because when you ask this question and I answer it and I say to you, look, if you look at ULTY, what are the top holdings? We've got NewScale in there. We have Unity. We've got Oklo, AppLovin, Upstart, INQ, AST. I could list all of these and then I could point you by contrast and say, well, we've got Abercrombie and MDB and Dell in the SLTY product. But this changes, right? It's going to change on those technical factors, and it's going to change based on the opportunity that the options market itself is presenting from one week to the next. So, arguably the best education you can get on the investment process for the respective strategies is to take a look at what they're actually doing. It'll do two things. It will give you complete transparency on what you're buying, right? So at any moment, you know what you get. For the dollars you put in, I have positions in the following ratios in the following assets and securities. But the other thing is, it also helps illustrate how dynamic these strategies are. And I don't want to describe them as complex, not in a worrisome way, but there's just a lot to the mechanics of affecting a strategy like this. And watching how these things change from day to day will give people some visibility, important visibility, and a better understanding, I think.
I love that. And I've seen channels rise, literally making content just on what's under the hood, what these ETFs are doing. And it's amazing. It's really interesting to watch and have, the educational aspect kind of push everyone's level, I should say, to the next level when it comes to understanding ETFs, and the ability to compound that with all the access to the internet, how we can learn things now, I think is amazing. It's one of the main reasons I started my YouTube channel, because it was cool to start to learn this and then share it and then discuss with other investors. So I appreciate that. And coming from some viewers, I have a couple of questions here. One thing very specific, I've talked about ULTY a lot on the channel. It is one of my favorite weekly pairs. There was a strategy change, and it might be a little bit complicated, but I've heard a couple different ideas of when the change actually took place. One idea is October, and one is more in the March range in 2025. And now I know that they started using different option strategies or had access to different option strategies. And maybe that's why we saw kind of a it took a little bit of time for those strategies to really be implemented, because the change in ULTY has been amazing. And props to you guys, props to YieldMax for that change. It's very, very impressive. But when did that strategy actually on paper change? And kind of how does that work when they start employing different option strategies?
All right, so
That
I'll
one's for
take this
Mike since
first. Yeah,
this
yeah.
happened before I got here.
Yeah, he's got an out on this one, but I'll let you explain the actual things that we added. So it's very important for everybody to understand that these high yielding covered call ETFs are new because regulations changed, right? So there was a 2019 rule that's called the ETF rule that made some more leniency here. Then you had the derivatives rule, which is really what broke the system to allow for this kind of thing to exist. I do not believe the regulators envisioned the existence of single stock ETFs when they made these rules, or strategies as complicated as ULTY and SLTY, right? That wasn't like in their roadmap of what they thought they were getting into. So when we launched ULTY, we put as many tools into it as we could and still get it through the regulators where they understood it. Then over time, they understand more and more pieces of it, and you're able to amend the prospectuses to add more strategies. The real change was the March, April end, and it really is the ability to not just use the synthetic long with the covered call. We now can do the synthetic long and then a call spread, right? And that call spread means, most of the time with these types of buy rights, you're capturing 70% of the upside of a stock and 90% of the downside. When you bring the call spread in, you can capture that 70, and then if it goes a little bit further, all of a sudden you're catching another tail, right? Because that call spread is the idea of selling a call and buying a call way up, right? So you have those days when something like MicroStrategy can shoot up 20. You might miss 8 to 12, but catch all of 12 to 20, right? That's what that call spread does for you. I think Mike can explain it a little more better than I can, but that's the general gist. Is the addition of those kinds of tools allowed us to keep up with the market when it collapsed in April, right? And then had this remarkable bull run that nobody thought would happen. ULTY was able to capture a lot of that through call spreads.
Interesting.
So yeah, I think, with one of the first things I would point out, and people may not be aware of this, but ETFs fall under something called the 40 Act, right? So, and why is this important? The 40 Act is so named, as many acts are, after the year they were enacted by Congress. And so this is 1940. Well, there weren't a lot of ETFs in 1940. And there weren't a lot of options being traded in 1940, at least not as listed tradable securities. So like I said, the concept of options goes back a millennia, but the common use of them as tradable listed securities in the United States actually only dates back to 1973, when what we now refer to as the SIBO, but the Chicago Board Options Exchange, first listed calls only on a small set of securities. Really, the broader point that's being made here is that the financial markets evolve and the regulators have to evolve with it. And I should always shut my phone off.
No worries.
Which I've actually gone on CNBC once or twice and forgotten to do that. I think I even did it in consecutive weeks one time. So, you have to understand that the regulators are also trying to catch up when it comes to things like this. Now, there is a dynamic which, Mike, I'm sure, has observed that is a little bit wonky in the options world. But let's talk about the first part, which is that if you sell upside, if you're long a stock and you sell upside, you want the stock to go up. No matter what happens, if the stock goes up, that's a good thing for you because you're long stock. At its core, it's a long position. There are circumstances where you have unusual upside moves. And a lot of people feel bad when they sell a covered call and a stock that they were bullish about doesn't rise 2% in a week or 3 or even 5, but it goes up 25% or 30%. You owned a stock, you liked it, and then all of a sudden it turns out Warren Buffett liked it too. And he decided he was going to buy that company out, and you sold the upside call, and you feel bad about that. When you sell call spreads, you're taking advantage of getting the basically the secular tailwind that occurs when you're collecting options premiums. But in that really unusual case where you have a price jump in the security, you still get some incremental participation if that move proves to be extraordinarily profound. That's one part of this. There is another part, which is sort of a broader issue, and this is just staying ahead of a big strategy that's only getting bigger in the marketplace. Let me sort of talk about that a little bit. As people become familiar with selling covered calls, and as more and more ETFs do it, let's say there's $150 billion under management in ETF strategies like this out of 14 or 15 trillion in ETFs. That's relatively small. But I think we can agree it's growing. ETFs are growing fast, and options-based ETFs are growing faster. So you put these in terms of compound annual growth rates for assets. If everybody says, oh, you know, what I would love to do is sell covered calls, eventually you get into a situation where you introduce some skewness. So you start pushing down upside call prices. If they're buying puts to hedge, they might push those up. That's a dynamic that can take place. Well, if you sell call spreads, let's just say that that had such a high volume that it actually had a market impact. The flexibility to sell call spreads means that you're actually able to take advantage of that dynamic because that skewness, as the calls dip in price, you're actually buying the calls that are lowest in price in vol space. So that additional flexibility means that you don't end up becoming a victim of your own success. And I'm not just talking about YieldMax or Title. I'm just talking about the industry in general. You know, if you are out there, it wouldn't matter what the strategy was. If we just said, hey, we're going to come up with a value-based stock picking ETF, and we have a handful of dynamics that we use. We look at price to sales, we look at price to earnings, we look at price to book, and whenever those numbers are low, we're going to sit there and buy them. And then those things become popular, they generate some alpha, people like them, and then there's a mad dash into it. Well, the more flexibility I have as a manager to respond dynamically to those changing market conditions, the better off I'm going to be relative to those that can't. ULTY and SLTY have more flexibility now than they did. Number one, because the regulators are becoming more educated. And number two, because as soon as you have that flexibility, if you have the skill and expertise and tools to take advantage of it, you should. It's just, you know, you want to be more nimble. Don't just give yourself one.
You know, Mike, I just want to chime in because you're now an ETF guy because you were so close on the number. I just looked on Morningstar. There's $141 billion in ETFs focused on derivative income. Not included in that number are those weekly payers that use leverage. So at least Morningstar's got it right.
What did I say? 150, and I said
Yeah.
100. Yeah, so I said 150, and the actual number is 141.
Yeah, it's pretty.
I would say I'm
That's
pretty close. I'm
that's
within
good.
90%. All right,
Like,
so
the price
I
is
won't
right.
beat myself up too bad.
You probably get the showcase on the prices right with that.
I went over though. That's the problem. I went over.
Yeah.
Interesting. Very interesting. Yeah, that's a definite good guess. Another user submitted question, another viewer question specific to ULTY is after the strategy or alter the strategy to trade 0 DTE puts on severe red days. Is there some sort of implementation you could do to help with downside protection? And I want to expand on it a little bit because that's a direct question. But because we've already seen strategy changes relatively consistently across the board with ETFs, looking into the future, can we assume that that trend will continue? Are we going to see improvements across the board with ETFs as more strategies are implemented and as regulators catch up with that? It's kind of a two-parter, if that makes sense.
Yeah. So I think that ULTY can already use 0 DTEs. That's my recollection of the prospectus. I don't know that we've used them very much, but let's just do a little history here. So the first ever, call it, derivative income strategy was this one by Kevin Rich that was called HVPW, or High Vol Put Right. It took him 2 years to get the thing launched because the SEC couldn't understand it. And by the time he got it launched, it was such a Frankenstein of a product with rules that it really was a failed product, right? It didn't do what it needed to do. I bring that up because the High Vol Put Right, I thought was, it was leaps and bounds innovation in ETF. But it was so hamstrung from rules that were trying to protect us to create a mess. So, for example, it had to follow an index. On the day before expiration, if somebody put 20 million into a $50 million fund, you're forced to sell a put that's got zero value, right? You're going to put 2 cents in and it's going to decay to nothing tomorrow, or you could get blown up, and that diluted the returns for everybody else, right? So some hedge fund figured that out and really destroyed the product, right? Like they just put money in, out. What we're doing over here at Title, and when we work with the YieldMax team and we work with our strategists like Mike, is constantly looking for more innovation, right? What else can we add to this to make it better? Or what else can we do to bring out another YieldMax fund that does another angle on these things? We think of ourselves as collaborative disruptors. We have a good dialogue with the SEC and with FINRA. We have 7 lawyers, right? That are, well, I think 4 lawyers on staff and 7 paralegals or something like that. We have a big legal department. And they have a great rapport with the regulators. Some of our competitors or other fund companies don't. They will just push something through. Every once in a while, you hear about a fund that, even State Street got in trouble this year with it, right? With the private credit thing. We don't push stuff through. We are collaborative and disrupting at the same time, or innovating at the same time. So yeah, things will continue to change. We'll continue to find things that are better. I think this single security ETFs, those are the ones we're not likely to change, because it's a clear exposure. It's democratization of a trade, right? You start to change that, your spreads blow out, but we can launch different versions of it. We can have Misty, and then we can have Misty, but only distribute 25%. So you keep more of the upside. That's filed and in negotiations with the regulators right now.
Oh, interesting.
Yeah.
Very cool. It's so interesting, the back end stuff that a lot of viewers don't understand, and I don't understand for sure, but it's so interesting. And I want to thank you guys again for coming on, because it exposes us to it. You learn a lot. And so next topic is macro and market perspective.
Well,
So
this is all Mike Khouw. This is all Mike.
All right, Mike.
You want ETF nerd stuff? I'll do it. You want macro? That's why we got our strategist. I'm just going to hit the mute button now.
No problem. No problem. Where do you see the biggest opportunities for income-focused investors over the next year?
Well, it's interesting. In terms of timing, my joining YieldMax was pretty well timed for me, because I was speaking at a conference in Las Vegas a couple months ago. And one of the things that I pointed out was that there's a lot of interplay between options-based strategies and things like rates, for example, that some people may not have given a whole lot of thought to. In the post-GFC era, one of the things that we saw was very low interest rates. So if you go back to the post-World War II era, 4% in the 10-year was about as low as we got. Short-term rates, which in some ways have more bearing on options valuations than the long-term rates do, those floated around a little bit more. But the reason this was important was because when we went to essentially zero interest rate policy, a couple things started to happen all at once. Number one, I'm sure people have heard of the concept of the Fed put. So the idea of the Fed put was that whenever risk assets began to exhibit excess volatility, monetary policy would come racing to the rescue to elevate those risk assets. And that had important implications for equity behavior. We got into a prolonged bull market. We want bull markets, by the way. We want the economy to do well. We want equities to do well. As I have often said in my experience, and I've lived through a couple bear markets, it's rarely good for anybody, including the people who were bearish ahead of time. That works out for a little while, but things just don't generally turn out well when the economy and the markets turn south. The other thing is that, just looking at covered calls as a simple strategy, the lower interest rates are, the lower the value of upside calls are, all else equal. And the reason has to do with what we call the cost of carry. The other thing I would say is that low rates also have an impact on what investors' expectations for corporate earnings yields are. Corporate earning yield, for those who don't know, is just the inverse of the PE ratio. So if the PE of the market is 20, then the corporate earnings yield is 5%, 1 over 20, right? So if the risk-free rate goes down, people's demand for corporate earnings yields go down, so multiples expand. So if you put all of those things together, what just happened? We had lower overnight rates that lowered the value of calls, all else equal, relative to puts because of the cost of carry. At the same time, we had an accelerated upside move in equities. Number one, because people thought the Fed put gave them some safety, and just because investor demand for corporate earnings yields also declined. And the point I was making when I was speaking earlier this year is that we're not going back to zero interest rate policy because we all have learned very painfully by now how that turns out. When you take on too much debt and you run zero interest rate policy for too long, you get inflation. And people, investors these days had not experienced that. We haven't had inflation like that in 40 years. And now people realize, okay, we liked zero interest rates, but not enough that we're willing to accommodate 9% year-on-year CPI. So what that means for investors is that while we can still have very good equity market appreciation, the cost of calls is going to remain a little bit more elevated, all else equal. And I think that creates a more favorable dynamic in the long run for covered call strategies. Covered call strategies on a risk-adjusted basis had, for a very long time, for decades, stacked up very favorably against long equity or 60-40 portfolios, a variety of strategies. It was, in fact, good enough that the University of Massachusetts and SIBO had commissioned a lot of studies and providing lengthy back tests of systematic covered call and covered put approaches. But, what we've seen since the GFC is, let's just call it a little bit unusual and for a prolonged period. I think as things normalize, as we get back to, a more normal rate curve and other dynamics that, strategies like this are likely going to see their relative performance improve. And so it was actually one of my big themes. So I think that's an important part of it. Obviously there's some other big shifting winds going on here in the AI space, the tech space, in crypto. We're seeing a lot more of that in Solana and Ethereum nowadays. It was Bitcoin before. I'm hoping that we don't continue to see gold appreciate quite as much. It was one of my core sort of themes for the last couple of years, but I don't think it's healthy to see the kind of appreciation that we've seen in the metals year after year after year, because it's indicative that there are some other fundamental problems. Hopefully we get those things under control. That's my hope and that's my expectation.
I love that. Yeah, gold I have a friend that loves gold, loves investing in it nonstop. I'll never forget, I had a professor in college on personal finance I asked him, should I buy gold, silver? He said, no, it's pointless. It underperforms, yada, yada, yada. I'm not sure if he's a professor anymore. He was a nice guy, but it was really interesting. I was like, oh, he kept saying, no, it's like an older person's way of investing. You're young, use more risk and whatnot. And I looked at the price of gold over the last decade. I was like, wow, bummer. But definitely interesting. And I am curious. So we've seen an interesting market. Yesterday, when we spoke, I talked about it being a red market. It wasn't a red market. It's just a little bit of a downtrend for a very short period of time. Risk management in these uncertain times. What do you think about it? How does it work with options? How does YieldMax handle the uncertainty?
Yeah, so again, the single stock positions are diversified. They're as undiversified as you can get, right?
Mm-hmm.
They're on a long-term basis. If you're not using them for income, you're going to end up capturing 70% of the upside, 90% of the downside of a stock, right? You're using them for income. It's a different kind of thing. So that's what they're designed for. There's no protection. However, we have the inverses, right? So instead of Misty, we have Winter. Instead of Coney, we have Fiat. Instead of NVDY, we have dips
Tesla
and
and
chips.
Crash.
Yeah, Tesla and Crash, favorite ticker. I don't know how we haven't won an award for that one. And then we have SLTY now and things like that. The Wall Street secret that they love to sell is diversification. You're not going to get rich being diversified. I'm a fiduciary. I'm now supposed to say, okay, so you have to protect your money and be diversified and all that sort of stuff. There's a different mindset out there now. That doesn't mean that if you have the proper risk tolerance, you can own a single position. I am going to reiterate, do not take a HELOC out to buy one of our single stock ETFs, right? I think I'm on the record with that a lot.
Mm-hmm.
That concentration is as risky as it gets, but it's also the thing that makes people rich. I'm not quite rich yet, right? Because I own a company. It's all tied up in the company.
Mm-hmm.
That's where all my risk has been for 13 years, right? And the risk that comes with that is paying bills and not making a real salary for 6 years and running through all your savings and, and not being able to quit. I always remind people that's the entrepreneurs do not have the freedom to quit. And that's a hard thing. You get diversification keeps wealth, concentration creates it, but it also can create zeros, right? So I don't know, Mike, you got anything to add to that? I'm kind of that reluctant entrepreneur. So
Well, I think that's, well, first of all, I think that's generally going to be true if you think of all of the, think of all of the biggest fortunes that have been made, not just in U.S. and American history, but just in history generally. And of course, there was some degree of concentration. Jeff Bezos made his money from Amazon, and Bill Gates made it from Microsoft, not from the S&P. Now, then you also have people like Warren Buffett, but Warren Buffett was an entrepreneur as well. He was drawing a $100,000 salary. He may still, actually, as far as I know, but he built a conglomerate, largely an insurance conglomerate, but it is a diversified industrial conglomerate, but he was building a company. So whether it's Ken Langone or any of these guys, they had considerable exposure to single names. Look, the thing about the single name products is that it is taking one of the difficult elements off the hands of the investor when they choose to do that. You've already decided that you like a premium collection strategy. You're looking to do covered calls. It is hard enough to pick stocks that you want to do it in, let alone also manage that. And by the way, there's a very good chance that a lot of people who do that are themselves entrepreneurs. And, whether you are operating a dry cleaner or something else, somebody else has got to be in front of all of these screens executing these strategies. Otherwise, you'd be doing it yourself, right? So the single stock strategies are because you've already gone through the heavy lifting of identifying the stocks that you want to be long or short. And in many cases, as Mike points out, we offer both, right? So you can pick your poison and go from there. Although I will say that the diversified products like ULTY and SLTY are more about the general investment approach. So you're going to say, I trust the investment approach. I trust the guys who are doing it for me. And I'm going to let them choose the stocks and use some of their techniques to do that as well.
Very interesting. Excellent. So we have a few more viewer questions. This one I got a couple of times. Very interesting. What happens when more shares of these ETFs are issued, and how does that impact the net asset value or NAV?
Yeah, no impact on the NAV at all. So the ETF basically was created in 1995 to replace the kind of derivative instruments that Mike was trading on the Philly back then, right? Or the Amex. Basically, the SEC wrote a paper saying we wish there was something that could handle the 1987 crash better. And they basically wrote a roadmap that Nate Most and a couple other guys, Burton Malkiel, Jay, not RJ, but they basically took that roadmap and created the ETF. The ETF structure, the main thing that it does that's different than a mutual fund is that it has intraday creation and redemption. So if there's more demand than shares outstanding that can be sold, intraday, we just create more shares of ULTY. Jay's team gets notified there's going to be this much more money in ULTY, match the trades, add to it. There's authorized participants that are hedging themselves all day long while helping to feed the tight spreads and the liquidity into these things. So there is zero impact on assets going into ULTY to the NAV. Where is the impact? And this is important. If ULTY was $30 billion, we wouldn't be able to run the strategy the way we do now. We wouldn't have 25 names. We'd probably have to have 150 names, because otherwise you'd be moving these underlying small cap names in one swoop. So we're always aware of capacity issues. We were aware of it with Misty, right? Misty has 5 prime brokers, right? Why? Because last November, all the prime brokers were like, I don't want to touch MicroStrategy. So now we said, let's get ahead of this. And in case it ever happens again that the street gets scared of MicroStrategy, we've got 4 to 5 different places to go to. So we always talk about there's about 150 people here at Title doing all the boring stuff for YieldMax, the compliance, the legal, operations, middle office, back office, administration, tax. There's 150 people that do this all day. That's the risk mitigation. Sometimes I hear on some of these other channels, like the Kilmer's guy, he's always like, I want to diversify away from just having YieldMax. What if they get hit by a hurricane? What is he talking about? We have 3 different trading desks in 3 different time zones and somebody in Europe. Like, the amount of infrastructure that is here is massive. You guys need to start asking who's trading this stuff for Round Hill? Who's trading this stuff for Granite shares? Who's trading it for Rex? Right? They need to come out and do like we do. Be very upfront, transparent, and honest so that people can make good decisions about their funds. Now, I'm not saying anything bad about Will Rind at Granite. I love the guy. I was at dinner with him the other night. And I worked with Greg King at Rex. We were partners in Global X together. So it's a small community, but I think the big important thing is YieldMax built the infrastructure to support an $18 billion franchise like YieldMax.
I've been on the other side of this because, you know, I served as the portfolio manager for an ETF at a smaller firm that had only about 10 people working for it. It's immensely unwieldy and it has operational risk, as Mike points out. You know, the truth is that back in the day when I was doing that, I should have been teaming up with the guys at Tidal and taking a lot of those other burdens off of my shoulders. A lot of actually the other service providers that Tidal and the YieldMax team use, by the way, I also did. So they service a lot of the industry. So I think people should recognize that as big as the team is, you know, it's even bigger in many respects because, you know, the custodian banks, you know, the executing and dealer brokers, which I distinguish between the two because, you know, from an options trader's perspective, it's important to have access to both. And we do. That's really quite critical as well. It's a business where scale matters. The more scale you have, not just because you have more bodies to cover things, but, you know, your operating cost, it means you can invest more to do things the right way. And I think that's important. Again, I'm not trying to be critical of everybody. I encourage people to set up ETFs. I think it's a great wrapper. More people should do it. As they do, a lot of them aren't going to be successful because it's not easy. It's non-trivial is the way I would describe it. It's a well-trodden path, but it is still an uphill path. Make no mistake. So you got to be in shape.
Yeah.
And you got to have the right team around you. I think that's important.
Wow. I'm curious as well with ULTY specifically. We watched the AUM go from a little over 200 million to what, 3.5 billion. From YieldMax's perspective, were you guys anticipating that? And how did it impact day-to-day work? I mean, did you have to make some big changes within the fund, like you were saying, Mike? Like, because all of a sudden there's so much more money involved? Or I just love the inside perspective on that whole run-up would be amazing.
So we didn't have to make changes. We're not, you know, I was talking about 10 times this size, like 30 billion, right? I think what happened is there was this cohort that never bought option income before, and it's the Bitcoin maxis. There's all these Bitcoin maxis out there who are struggling with, I don't get any money out of my Bitcoin. I'm not willing to sell it. I can't extract anything out of it. So I think through a number of different influencers, British Hodl and a couple others, Dark Side, this Bitcoin maxi world learned about Misty. And Misty went from like 1 billion to 5 billion in like 4 months. I think once they got here and they saw what Misty was doing, they were peeking around the sides. Oh, wait, here's this ULTY thing. It pays weekly and it's cranking out this dime every week. And I think there was a lot of people who got introduced to this because of Misty that then found ULTY. Were we anticipating that? No. Did we do any special marketing thing that got it there? No. I do think it's really important that, you know, we recognize this community, right? So we did the event at the NASDAQ where many of you guys came and created content. YieldMax took in 3.7 billion since that event. I'm not going to say that event, let's give 10% credit to that event. And it's still an amazing number.
Yes.
Right. So it's the education. It's why we brought Mike Khouw to the team. It's the transparency that we offer. I think that's why people come for it. There's critics too. We see them all the time, but we're just going to do it the best we can and keep going.
Wow. Very interesting. I love that look kind of under the hood with it. And I get the comments all the time. Why is ULTY down today? Well, the underlyings are down. It's not going to go up when everything is down, you know? I get those.
The Dow's down 900 points and ULTY's down like
well, it's dropping.
50 bips. They're like,
oh,
I don't know how.
I'm not selling, you know, everything's down today. It's what we've seen. So and it's interesting, the difference with ETFs and stocks and kind of bridging that gap with the educational standpoint. I initially invested in dividend stocks. The ETFs, I only started a couple of years ago, especially when the weeklies became a thing. And now it's kind of my bread and butter content. People love knowing what's happening with the weeklies. And we've seen the number go from, I mean, 8 at the beginning of the year, or maybe a few months prior to that to now, we have roughly 50. So it's popular. YieldMax has been putting out some absolutely phenomenal ones. We've seen some really interesting shifts, specifically with ULTY going from monthly to weekly. And I'm curious, is there room within the current monthly pairs from YieldMax? There's some big names in there, the original Coney, Tesla. Is there any potential for them to convert to a weekly pair, or do the options not allow that?
So we talk about it all the time. I'm not going to say which fund, but one of the monthlies is going to become weekly soon, and it
Interesting.
lets us test it. It's not optimal to go weekly, right? The reason the leverage funds can go weekly is they're not doing anything, right?
Yeah.
For us, if we're going weekly, then I got to really have Scott and team and Matt. They've got to like try and guess the target instead of spread the options out over where it's most optimal, right? Sometimes it's optimal to go 9 days out, and sometimes it's optimal to go 6 days out. And if you're being forced to always have cash, that can be problematic. I do think that the YieldMax team understands that this community wants to get paid every day.
Hmm.
So I think we're working towards a plan where there'll be kind of groups that pay Monday, groups that pay Tuesday, groups that pay Wednesday, and things like that as we continue to proliferate the products and think through the scheduling. So I'm not saying no. I'm not saying that they'll never go weekly, but we're going to test someone and see how it goes. And a lot of the newer products, we go out weekly. Yeah, I think that's where we're at the moment.
Right.
Yeah,
Very
I
interesting.
think, I mean, yeah, we've already broken out the weekly payers the monthly payers into weekly groups,
Hmm.
so that folks that have money allocated to more than one product actually can get a weekly distribution. And, if such a mechanism was broadened out, I mean, to Mike's point, you know, one of the things that we talked about earlier as we've been discussing this was giving the manager some degree of flexibility. The more you start saying, okay, well, what if we imagine, let's take this argument ad absurdum. So, okay, well, most people go and they work and they know how much they're making per hour. Can you guys distribute it hourly? I mean, this would be, it would be ridiculous. That would be the only thing people would even if you could say that was possible from a regulatory standpoint, which I'm pretty certain it is not at this point. It would just be operationally too complex, and it would not benefit the managers, and it would not benefit the investors. This goes into the category of careful what you wish for,
Hmm.
right? So there's a balance to be struck between what investors want and expect, which should be good total returns, net of taxes. That's your ultimate objective as an investor in general, and what they think they want, which is pay me now. I mean, always be paying me now. Just to hold your hand out and have people fanning T's and C notes at you all day would be it'd be fun, I'm sure, but that's not practical.
Hmm. Very interesting. So daily dividends are pretty much off the table at this point.
Well, like I said, we're looking for ways to have YieldMax have a product that pays every day,
Hmm.
but it wouldn't be one product. It
One
would be
specific.
multiple. Yeah. So the
Very,
other thing
very
that,
interesting.
I've talked to Jay about this a lot. One of the big things that would be problematic with it going weekly is like NVDY. Next week, it would pay a massive dividend because it was earnings season.
Hmm.
And then it could go down by 50, 60% for the next 3 weeks. So you're going to have, a press release that says 110% yield.
Hmm.
And then the next week it's going to say 50. And is that really helping anybody, or is that just confusing people? Like if they buy around earnings, it's going to look like a really, really amazing yield. Whereas right now we're, using 4 weeks and capturing all kinds of different market environments. I don't know. Believe me, we debate it internally often. And at the end of the day, we're a fiduciary. So we're going to do what we think is most right for investors, not just what everybody's asking for.
Hmm.
So there'll be a lot of weekly products, but I don't know if it's going to be every single stock one.
Hmm. Very good. I love those insights. And the final question, it's something I'm sure you guys get asked all the time, and it's in a way a two-parter, but I get comments nonstop, is are YieldMax ETFs good for the long term? But you can't simply just give a yes or no, I would say. Maybe you have a different opinion, but I want to know, what do investors need to know in order to answer that question for themselves?
All right, so I'll start and then we'll go to Mike Khouw. YieldMax, UMAX. Yeah, good for the long term. ULTY, good for the long term. YMAG, LFGY, GBTY. the more diversified ones are no problem for the long term.
Mm-hmm.
The ones that are single stock, if you would buy and hold Tesla for the next 10 years and you would prefer to get income from it, Tesla is fine for 10 years. It's the risk that you're taking is the idiosyncratic risk of the underlying. So there are plenty of people I know who've owned NVIDIA for, 10 years, and they're very happy with it. If they wanted income from it, they just peel off a little, or they use some margin to buy some NVDY. So that's my take on it. You have to know which way your bias is on a stock. If you're somebody who likes to swing trade strategy, then you should be moving from winter to misty over and over and over again. Mike?
Yeah, I mean, well, first of all, is it possible to own a single stock for a prolonged period and do well? And the answer is clearly yes. I mean, only looking at the end of quarter pricing, NVIDIA on a split adjusted basis was less than 4 cents a share at the end of the second quarter of 1999. And had you been engaged in a strategy like the NVIDIA strategy is, in just that one stock for the 26 years since then, it would have been a spectacular thing to have held for maybe the bulk of most people's working lives. I sure wish that that was what my 401k looked like, right? But the truth is, we don't know. We don't know what the next NVIDIA is. We don't know whether NVIDIA is the next NVIDIA. It's unlikely, considering it's $4.3 trillion, and the law of large numbers suggests that those kinds of returns would mean that NVIDIA is largely swallowing the entire economic world if it was to do the same thing and compound at the same rate over the course of the next 25 years as it has over the last 25. But that doesn't mean that a lot of these other companies don't have massive growth opportunities, are not fantastic investments. And the other thing, I think this is an important just thing in general, which is things change. Things change in the economy. Things change at a company. You can have companies that were once great and fall apart, and you can have companies that just seemed like a complete disaster. New management comes in and turns them around. So on the single stock side, that's going to be the challenge. The challenge is always, that's not a question for us. That's a question for you. That's a question for you, the investor, to make when you're looking at a single stock product, whether or not that business actually has what it takes. And there are plenty of retail investors that have outperformed a lot of great long-only equity managers by figuring that one out on their own. This is just layering a strategy on top of that underlying thesis. And for that, I think if you get that first part right, then a YieldMax strategy, whichever one or underlying it is going to be a good thing to be invested in. You get that wrong, and then I'm sorry, you get the first part wrong, and trouble follows. So for anything that's going to be long equities, you want those equities to be going up. And if you're only laying it on one of them, that's you're not really spreading a lot of chips around the board in that case. You might be right, and I hope you are. I don't know the answer.
Excellent. Well, I want to say thank you again for hopping on the channel, for taking the time. I know you have very busy schedules and some more important things to do. So I appreciate you guys coming on, helping educate not only me, but the audience. And I was curious, do you guys have any closing thoughts, any comments you want to leave with the audience?
I just like to say, I love this way of communicating, like through, direct to each other and discussing it in the comments. I'm also big into crypto. I've been early there. I run a blockchain fund, and I always tell people who ask me, well, should I try this coin? Yeah, buy a little bit and learn, right? When you have, don't YOLO everything into something, right? If you're new to this, buy $100 worth and watch how it works and understand it. I don't care if people buy Dogecoin, but it should be with 0.0001% of your net worth. And then once you understand it, you can make more educated investments. So to me, anything new is about buying and learning. You start small, and so many people have started small and become huge. Mike, parting thoughts?
Yeah, I would say, you just said we have more important things to do. In my case, I'm not sure there is something more important for me to do than this. This is kind of the ideal format as far as I'm concerned. I've spent a lot of time in front of a TV camera talking for a very short amount of time about things that are going on in the market. And you can't educate people that way, but you can educate people this way. And the other thing is they can educate us, because conventional approaches in the investment world don't leave us a whole lot of feedback so that we get to hear what people understand, don't understand, and frankly, a lot of their ideas. And often they're good ideas. and we need to listen to them too. And this is a great format for that. So for having us participate, I really appreciate it. Thank you.
Of course. Well, anytime you guys want to jump back on, you're more than welcome.